Insurance is a cornerstone of financial stability for the average middle-class American. It is designed to shield individuals and families from catastrophic financial loss when disaster strikes. Whether it's a car accident, a house fire, or a severe medical emergency, the promise of insurance is to provide peace of mind and financial security in the face of uncertainty. People purchase insurance policies not because they want to use them, but because they need to feel protected from life's unpredictability. Yet, for far too many, the reality of making an insurance claim reveals a stark and disheartening truth. Insurance companies often fail to deliver on their promises. Instead of providing the security they advertise, they employ strategies that leave policyholders frustrated, financially strained, and often devastated. This playbook, encapsulated in the phrase delay, deny, defend, has become a defining feature of how insurance companies operate today. Insurance companies make bold promises in their advertisements. Slogans like a good neighbor, State Farm is there, or you're in good hands with Allstate, build an image of reliability and trust. These slogans suggest that insurers will come through when policyholders need them most, acting as a supportive partner in times of crisis. Yet, the harsh reality for many is the opposite. When claims are filed, insurers frequently delay payments, deny legitimate claims outright, or defend aggressively in court, forcing policyholders to fight for what they are owed. These tactics are not isolated incidents but are woven into the fabric of how many insurance companies conduct business. The book begins with striking examples that highlight the human toll of these practices. Cindy Robinson, a policyholder who believed her auto insurance would cover her medical expenses after a debilitating car accident, discovered firsthand how insurers prioritize profits over promises. Her insurer delayed payments for months, leaving her to shoulder mounting medical bills alone. It took her 3 years, multiple surgeries, and hiring a lawyer to finally receive the compensation she was entitled to under her policy. Similarly, Thomas Anderson's experience with his homeowner's insurance after a devastating water leak paints a grim picture of what many policyholders endure. Despite paying for a deluxe homeowner's insurance policy, Anderson found himself battling his insurer for years to receive enough money to make basic repairs to his water-damaged home. By the time he received the settlement, his family had endured 5 years of stress, legal fees, and disruption. Stories like these are not outliers. They reveal a systemic issue within the insurance industry, one that undermines the very foundation of trust between insurers and their customers. Insurance is fundamentally a promise. Policyholders pay premiums to transfer their financial risks to the insurance company, trusting that the company will fulfill its end of the bargain when disaster strikes. This promise is not a luxury but a necessity, offering a financial safety net in life's most vulnerable moments. Yet, as J.M. Feinman explains, the profit-driven strategies of modern insurers often come at the expense of the very people they are meant to protect. The historical roots of insurance lie in a sense of community and mutual responsibility. Benjamin Franklin's Philadelphia Contribution Ship, founded in 1752, exemplified this principle. Homeowners pooled their resources to protect one another against fire damage, sharing both the risks and the costs. Over time, insurance evolved into a massive industry, with companies collecting billions of dollars in premiums annually. Yet, in this transformation, the sense of mutual responsibility gave way to corporate profit motives. Modern insurance companies are driven by shareholder expectations and competitive pressures, leading to a shift in priorities. Instead of focusing on fulfilling their promises, insurers now emphasize minimizing payouts to maximize profits. This shift became especially pronounced in the 1990s, when consulting firms like McKinsey & Company introduced new approaches to claims management. McKinsey's methods redefined the claims process as a zero-sum game, where every dollar saved on claims directly boosted the company's bottom line. Under this framework, claims departments transformed from service-oriented entities into profit centers. Adjusters, once tasked with helping policyholders during difficult times, were now evaluated based on how much they could save the company. The focus shifted from fair and prompt resolution of claims to strategies that delayed, reduced, or outright denied payouts. The delay, deny, defend playbook emerged as a systematic way to exploit the claims process. Delaying payments allows insurers to hold onto premium funds longer, earning investment income on the money that should have gone to policyholders. Denying claims, even when they are valid, forces customers into exhausting battles to prove their case. When policyholders push back, insurers often resort to aggressive litigation, using their vast resources to outlast individuals who lack the financial means to keep fighting. These tactics are not only unethical but also disproportionately harm those who are most vulnerable, people dealing with injury, loss, or significant life disruptions. Feinman highlights that this transformation is not an accident but a deliberate strategy. By limiting payouts, insurers reduce their largest expense and significantly increase their profitability. For example, delaying claims payments allows companies to generate income on the float, the time between collecting premiums and paying claims. Industry leaders, like Warren Buffett of Berkshire Hathaway, have openly celebrated the profitability of float, underscoring how delays benefit insurers financially. While this may be good for the company's bottom line, it comes at a steep cost to policyholders, who are left to navigate mounting bills and financial uncertainty. The systemic nature of these practices has far-reaching consequences. They not only erode trust in the insurance industry but also undermine the financial stability of families and communities. Insurance is supposed to act as a safety net, protecting individuals from catastrophic losses. When that safety net fails, the consequences can be devastating. Families face financial ruin, homes go unrepaired, and accident victims struggle to access medical care. These failures strike at the heart of what insurance is meant to provide: security and peace of mind. Feinman's introduction sets the stage for a deeper exploration of how and why insurance companies prioritize profits over promises. By exposing the inner workings of the industry, he challenges readers to reconsider their understanding of insurance. The stories and insights presented in the book not only highlight the problems but also provoke critical questions about how to reform a system that so often leaves policyholders vulnerable. Insurance is essential to economic security, but for it to fulfill its role, insurers must be held accountable to the promises they make. Without meaningful change, the strategies of delay, deny, defend will continue to erode the trust and stability that insurance is supposed to provide. Insurance is built on a concept as old as human civilization: risk sharing. At its core, it offers individuals the opportunity to trade a small, predictable loss, the payment of premiums, for protection against potentially devastating financial consequences. This simple exchange underpins a trillion-dollar industry that touches nearly every aspect of modern life. Whether it's auto insurance protecting against accidents, homeowners insurance safeguarding property, or health insurance mitigating medical expenses, the fundamental premise remains the same. The insured pays for peace of mind, and the insurer promises to bear the financial burden of specific risks. The origins of this system can be traced back to mutual aid societies, like Benjamin Franklin's Philadelphia Contributionship, which pooled resources to help homeowners rebuild after fires. Over centuries, this community-based model evolved into the corporate insurance giants we know today. Companies like State Farm, Allstate, and Geico process millions of claims annually, collecting billions in premiums. These insurers promise their policyholders security in the face of adversity, a pledge that is foundational to the relationship between consumer and insurer. The process begins when a consumer purchases an insurance policy, effectively entering into a contract with the insurer. This contract specifies the types of risks covered, the circumstances under which claims will be paid, and the obligations of both parties. While these contracts are often lengthy and filled with technical jargon, the central promise is straightforward. The insurer agrees to compensate the policyholder for covered losses. Insurance operates on the principle of pooling risk. A company collects premiums from a large number of policyholders, knowing that not everyone will experience a covered loss simultaneously. This allows the insurer to use the premiums paid by many to cover the claims of the few who suffer losses. This pooling is backed by extensive actuarial data, with companies analyzing historical trends, accident rates, weather patterns, and countless other variables to calculate the likelihood of losses and set premiums accordingly. In theory, this system should work seamlessly. Policyholders pay premiums, the insurer holds these funds in reserve, and when a covered loss occurs, the company pays the claim. From the insured's perspective, A covered event should trigger a straightforward process. The claim is filed, evaluated, and paid promptly. In an ideal world, this financial transaction would come with the additional benefit of emotional security insurance, providing not just financial reimbursement, but also the peace of mind that comes with knowing you are protected from life's uncertainties. However, the process is more complex in practice. The insurance industry is driven by financial calculations and economic pressures that shape every aspect of its operations. For insurers, the goal is to maintain a delicate balance. They must collect enough premiums to cover claims and operating costs while generating a profit. To achieve this, companies rely on a combined ratio, which measures their total expenses, including claims payouts and administrative costs, against their premium income. A ratio under 100 means the company is profitable on underwriting alone, while a ratio over 100 requires investment income to offset losses. Investment income is another critical component of the insurance business model. Insurers don't simply hold onto the premiums they collect. They invest this money in financial markets to generate additional revenue. This investment period, known as the float, is a significant driver of profitability. Even a company with a combined ratio slightly above 100 can turn a substantial profit through strategic investments. As Warren Buffett famously stated, insurance companies are essentially investment companies that raise the money for their investments by selling insurance. The longer an insurer delays paying claims, the more they can earn from their float. This financial structure makes claims management one of the most critical areas for insurers. While paying claims promptly and fairly should be the primary function of a claims department, it is also the single largest expense for most insurers. Consequently, reducing claim payouts directly boosts profitability. This tension between fulfilling contractual obligations and maximizing profits sets the stage for the practices described in later chapters. Delay, deny, and defend. Traditionally, claims adjusters were tasked with evaluating losses, determining what was owed under the policy, and paying claims promptly. This role was guided by ethical principles and industry standards, with adjusters encouraged to act in good faith. As Feinman notes, the essence of the claims process was captured in a simple maxim: we pay what we owe. The adjuster's job was not to protect the company's profits but to uphold its promise to policyholders. But beginning in the late 20th century, this approach began to change. Insurance companies, facing pressure to improve profitability, redefined the claims process. Claims departments were no longer seen as cost centers fulfilling a service but as profit centers that could be optimized for financial gain. This shift marked a turning point in the industry, as claims handling became less about individual judgment and more about adhering to corporate strategies designed to minimize payouts. The rise of data-driven claims management further transformed the industry. Insurers began using sophisticated algorithms and computer systems to determine settlement offers, often with little regard for the unique circumstances of individual claims. These systems, while efficient, prioritize financial metrics over fairness. For example, if an algorithm determines that most claimants will accept a lower settlement to avoid litigation, the company is incentivized to offer less than what is truly owed, knowing that only a small percentage of policyholders will push back. The foundation of insurance as a protector of financial stability remains intact in theory. However, the execution of this promise has been compromised by the industry's profit-driven evolution. As Feinman explains, the claims process is no longer guided by a commitment to fairness, but by strategies that prioritize corporate interests. This shift has profound implications for policyholders, who increasingly find themselves navigating a system designed to maximize profits rather than deliver on promises. The traditional understanding of insurance that policyholders pay premiums in exchange for reliable protection still holds powerful appeal. It is why millions of people continue to trust insurance companies with their most significant risks. Yet, as the book reveals, the system has been reshaped in ways that often leave policyholders fighting for the coverage they believed they had purchased. By understanding how insurance works and how it has been transformed, consumers can better prepare themselves to navigate an industry that does not always act in their best interest. Insurance fails when companies prioritize their bottom line over their promises. While insurance is sold as a safeguard for policyholders, the practices of delay, deny, and defend reveal an industry that often operates contrary to its core purpose. Insurance companies make their largest profits by reducing the payouts they owe, and to achieve this, many have shifted from honoring claims fairly to systematically exploiting their customers. The transition from a customer-oriented service to a profit-maximizing strategy has left countless policyholders feeling betrayed, often at the most vulnerable moments in their lives. One of the most common ways insurance fails is through delays. When insurers stall the payment of claims, it serves two purposes. It allows the company to hold onto money longer, earning more investment income, and it pressures policyholders to settle for less than they are owed. Delay tactics often start with seemingly benign requests for additional documentation or further investigation, even when all relevant information has already been provided. These tactics are designed to wear down claimants, many of whom are in desperate financial or emotional situations and cannot afford prolonged disputes. Consider the case of Kim Zilish. After suffering permanent injuries in a car accident, Zilish filed a claim under her underinsured motorist coverage with State Farm. Despite providing all necessary medical records, State Farm delayed her claim for over a year, demanding unnecessary reports and subjecting her to repeated examinations. Even after their own investigations confirmed her injuries were severe, the company continued to stall, forcing Zilish into arbitration before finally paying the policy limit. For Zilish, the delay not only caused financial hardship but also compounded the emotional and physical stress of recovering from her injuries. Her story illustrates how delay is often less about ensuring a fair assessment and more about leveraging power over policyholders who need their claims resolved quickly. Delays are not limited to individual claims. They become particularly egregious after large-scale disasters, when thousands of policyholders file claims simultaneously. After Hurricane Katrina, for example, insurance companies faced a deluge of claims from homeowners whose properties had been devastated. Instead of acting promptly, many insurers delayed payments by disputing the causes of damage, arguing whether destruction was caused by wind, covered, or water, not covered. For policyholders, these delays meant months or years without the resources to rebuild their homes or lives. The Louisiana Department of Insurance received complaints from more than 20,000 policyholders per month during the first 6 months after Katrina, highlighting the widespread nature of these tactics. When delays are not enough to reduce payouts, insurers often turn to outright denials. Denying claims allows companies to avoid payment altogether, even when those claims are valid. To justify these denials, insurers frequently rely on narrow interpretations of policy language or exploit ambiguities in coverage. The denial process often preys on the fact that most policyholders are not legal or insurance experts and may not fully understand their rights. For instance, Kristen Dines suffered a broken pelvis, nerve damage, and kidney failure after being struck by an uninsured driver. Although her auto insurance policy provided coverage for such losses, State Farm initially denied her claim, using misleading statements to dissuade her from pursuing it. An adjuster falsely told Dine that her claim was not covered and that filing it would result in higher premiums. Even after the company's own lawyer confirmed the claim was valid, State Farm continued to deny payment, forcing Dine to sue. This case demonstrates how insurers use denial not as a tool to uphold policy terms, but as a strategy to deter claimants from pursuing what they are owed. Another example is Reagan Wilson, who was injured in a car accident caused by a drunk driver. Despite clear evidence of her injuries, her insurance company, 21st Century, denied her claim, arguing that her neck and back injuries were pre-existing conditions. This assertion was made by an adjuster with no medical expertise and directly contradicted the diagnoses of Wilson's doctors. The company's denial forced Wilson to undergo unnecessary medical examinations and file a lawsuit to prove the legitimacy of her claim. It was only after 2 years of litigation that the insurer finally agreed to pay. In some cases, denial tactics border on the absurd. Companies have been known to investigate claimants' personal lives in an attempt to find any reason to deny coverage. For example, after a car accident left Leandra Pitts with a traumatic brain injury, her insurer, Progressive, hired private investigators to secretly surveil her. These investigators infiltrated her church under false pretenses, attending confidential support group sessions and even recording members' private confessions. While the investigation yielded no evidence against Pitts, it revealed the lengths to which insurers will go to avoid paying claims. When delay and denial fail to discourage claimants, insurers often resort to aggressive litigation. This final tactic, defend, involves fighting claims in court to exhaust policyholders both financially and emotionally. Litigation is not just a legal strategy but a deliberate attempt to make pursuing a claim as difficult as possible. Insurers rely on their vast resources and legal expertise to outlast claimants, many of whom cannot afford prolonged court battles. The use of aggressive defense is especially evident in cases involving minor impact, soft tissue, missed injuries, such as whiplash. Insurers often argue that such injuries are exaggerated or fraudulent, offering lowball settlements or refusing to pay altogether. These cases are particularly vulnerable to the defend strategy because the costs of litigation often outweigh the potential compensation. By forcing claimants into court, insurers deter many from pursuing their claims, effectively reducing payouts through intimidation. A striking example of this strategy comes from Farmers Insurance, which refused to settle a wrongful death claim for a policyholder killed in a collision with a drunk driver. Despite overwhelming evidence of liability, including the driver's criminal conviction, Farmers prolonged the case for years, forcing the victim's family to endure a grueling legal battle. The company's refusal to settle resulted in a jury awarding punitive damages against Farmers for its bad faith handling of the claim. While the family ultimately prevailed, the case underscores the emotional and financial toll of fighting an insurer that is determined to defend its profits at all costs. The cumulative effect of these tactics delay, deny, and defend is the erosion of trust in the insurance industry. Policyholders purchase insurance to protect themselves from financial ruin, yet they often find themselves in a worse position after filing a claim. Instead of providing security and peace of mind, insurance companies exploit their customers' vulnerabilities, leaving many to question whether the promises made by insurers are ever truly reliable. Feinman's analysis reveals that these practices are not accidents or isolated incidents, but systemic strategies embedded in the industry. Insurers are incentivized to minimize payouts because every dollar saved in claims is a dollar added to profits. While this approach benefits shareholders, it comes at a tremendous cost to policyholders, who are left to navigate a system designed to prioritize corporate interests over individual needs. Insurance fails not because it is inherently flawed, but because the industry has chosen to sacrifice fairness for financial gain. The widespread adoption of delay, deny, defend strategies in the insurance industry is not accidental. It is the result of systemic changes that have prioritized profitability over the original purpose of insurance: to provide security and stability to policyholders in times of need. These changes began in the late 20th century and have fundamentally altered how insurance companies operate, transforming them into profit-driven entities where customer service and fair claims processing are secondary considerations. J.M. Feinman explores how these shifts occurred, why they became entrenched, and the systemic forces that perpetuate them. A pivotal moment in this transformation came when large consulting firms, particularly McKinsey & Company, began advising insurance companies on how to overhaul their claims processes. In the 1990s, McKinsey introduced a new framework that redefined claims as a zero-sum game. This approach viewed every claim as a direct competition between the policyholder and the insurer for the same pool of money. Every dollar paid to a claimant was seen as a dollar lost to the company. This marked a significant departure from the traditional role of claims departments, which had been focused on fulfilling the company's promise to policyholders by paying legitimate claims promptly and fairly. Under McKinsey's guidance, insurers shifted their focus from customer service to profitability. Claims departments, which were previously seen as cost centers, became profit centers. The goal was no longer to evaluate claims based on merit but to manage them in a way that minimized payouts. Adjusters, once entrusted with discretion to determine fair settlements, were now instructed to follow rigid protocols designed to reduce costs. This shift not only changed the role of claims adjusters but also fundamentally altered the relationship between insurers and their customers. One of McKinsey's key innovations was the use of data-driven systems to manage claims. These systems relied on algorithms to calculate settlement offers based on historical data and statistical averages. While efficient, These algorithms often ignored the unique circumstances of individual claims. For example, if the data suggested that most claimants would accept a low settlement to avoid litigation, the system would recommend offering less than what the policyholder was truly owed. This approach was particularly effective for minor impact, soft tissue, missed claims, where the costs of fighting a denial often outweighed the potential compensation. By setting lowball offers as the default, insurers created a system where the majority of claims could be settled cheaply, with only a small fraction of policyholders pushing back. This redefinition of claims handling as a profit-driven activity was not limited to McKinsey's clients. Other consulting firms and industry leaders quickly adopted similar strategies, and these practices spread across the industry. As Feinman notes, insurers began to see claims not as obligations but as opportunities to maximize financial gains. This shift was reinforced by the structure of the insurance business itself, particularly the importance of float. Float refers to the time between when an insurer collects premiums and when it pays claims. During this period, the insurer invests the money and earns returns. The longer the company can delay paying claims, the more profit it can generate from its investments. This creates a powerful incentive to stall the claims process, even when the delay causes significant harm to policyholders. Warren Buffett, whose Berkshire Hathaway owns Geico and other insurance companies, famously described float as one of the most attractive features of the insurance business. While this approach makes sense from a financial perspective, it has devastating consequences for individuals waiting for their claims to be resolved. The systemic emphasis on profitability over fairness also manifests in how insurers train their employees and structure their operations. Adjusters are often evaluated based on metrics like the percentage of claims they settle for less than the policy limits or the number of claims they close without payment. These metrics incentivize adjusters to focus on minimizing payouts rather than providing fair and prompt service. In some cases, insurers even reward employees who are particularly aggressive in denying claims. For example, Unum, a major provider of disability insurance, became infamous for awarding employees with prizes like the Hungry Vulture Award for denying claims. These practices create a culture where policyholders are seen not as customers but as adversaries. Another systemic issue is the lack of effective regulation. Insurance is one of the most heavily regulated industries in the United States, with state insurance commissioners responsible for overseeing company practices. However, much of this regulation focuses on ensuring that insurers remain financially solvent, rather than protecting policyholders from unfair treatment. For example, regulators closely monitor whether companies have sufficient reserves to pay future claims, but often fail to scrutinize how those claims are handled. Even when companies engage in blatant bad faith practices, enforcement actions are rare, and penalties are often insufficient to deter future misconduct. This regulatory gap leaves consumers vulnerable, particularly because they lack access to the information needed to make informed decisions. Unlike buying a car or a television, where consumers can compare performance metrics and reliability ratings, purchasing insurance involves significant uncertainty. Most people have no way of knowing whether their insurer will pay claims fairly until they actually need to file one. The industry's reluctance to disclose data on claims practices further compounds this problem. While insurers invest heavily in advertising to build a positive public image, they are notoriously secretive about their internal operations. For example, companies have fought fiercely to prevent the release of documents detailing how claims processes were redesigned to prioritize profits over fairness. The systemic nature of these issues becomes even more apparent in the aftermath of major disasters, when the flaws in the system are magnified. After Hurricane Katrina, thousands of homeowners discovered that their comprehensive policies excluded flood damage, even when the damage was caused by storm surges directly related to the hurricane. Many policyholders were forced to file lawsuits to recover even partial compensation, and insurers used delay tactics to wear them down. The result was a widespread erosion of trust in the insurance industry, as families who thought they were protected found themselves abandoned in their time of greatest need. Feinman emphasizes that these systemic issues are not the result of a few bad actors, but are deeply embedded in the industry's structure and incentives. Insurers operate in a competitive market where profitability is paramount, and the strategies of delay, deny, and defend have proven highly effective at boosting the bottom line. While these practices benefit shareholders and executives, they come at a significant cost to policyholders and the broader public. The shift from fulfilling promises to maximizing profits has turned what should be a relationship of trust into an adversarial struggle, leaving many consumers disillusioned and unprotected. Ultimately, Feinman argues that the systemic causes of delay, deny, and defend are a product of a broader cultural and economic shift. As insurance companies have grown larger and more profit-driven, the emphasis on mutual responsibility and trust that once defined the industry has diminished. Restoring that sense of trust will require not only stronger consumer protections and more effective regulation, but also a cultural shift within the industry itself. Until that happens, the systemic forces driving these practices will continue to undermine the essential purpose of insurance, providing security and peace of mind in an uncertain world. The consequences of the delay, deny, defend strategy ripple far beyond individual claims. These practices have fundamentally eroded the relationship between policyholders and insurers, undermining trust in the industry and exposing systemic vulnerabilities that affect individuals, families, and entire communities. When insurers prioritize profitability over promises, the damage extends not just to the financial stability of those who rely on insurance but also to the broader social contract that insurance was designed to uphold. J.M. Feinman explores these impacts with a focus on both the human and societal toll. For individuals, the most immediate impact of these practices is financial. Insurance is often the last line of defense against catastrophic losses, whether from a car accident, a natural disaster, or a severe illness. When an insurer delays or denies a valid claim, the policyholder is left to shoulder expenses that they are neither prepared for nor capable of managing. In many cases, this forces individuals to drain savings, take on debt, or forgo essential repairs or medical treatments. Take the example of Terry Buttery, a homeowner who filed a claim with Hamilton Mutual after his home was burglarized and vandalized. Despite promptly submitting all required paperwork, Buttery's claim was delayed for years. He provided receipts, repair estimates, and even 5 years' worth of tax returns, yet Hamilton Mutual continued to stall. It wasn't until Buttery sued the company and won a court judgment that he received the compensation he was owed. However, even after the Kentucky Supreme Court upheld the judgment, Hamilton Mutual refused to pay until Buttery threatened to take legal action against their bond. The financial strain and years of uncertainty took a toll on Buttery, illustrating how insurers weaponize delays to wear down claimants. This financial impact is amplified during large-scale disasters, where the failure of insurance systems leaves entire communities in crisis. After Hurricane Katrina, hundreds of thousands of policyholders filed claims, expecting their insurers to help them rebuild. Instead, many faced denials based on narrow interpretations of policy language. Insurers argued that damages caused by storm surges were excluded under flood provisions, even when the flooding was a direct result of the hurricane. This left countless families unable to repair their homes or replace their belongings, compounding the devastation of the disaster. Many turned to lawsuits as a last resort, but the legal battles often dragged on for years, delaying recovery efforts and deepening the emotional toll. The emotional impact of these practices is profound. Insurance claims are often filed during some of the most stressful moments in a person's life after an accident, injury, or disaster. Policyholders trust that their insurance will provide not just financial support but also a sense of security and stability. When that trust is betrayed, the psychological toll can be as significant as the financial one. The constant back and forth with adjusters, the uncertainty of whether a claim will be paid, and the feeling of being stonewalled by a company that promised to be a good neighbor create immense stress and frustration. For many, the experience of fighting their insurer is a second trauma, compounding the initial event that led to the claim. These practices also have a chilling effect on the willingness of policyholders to file claims at all. Knowing the obstacles they may face, many individuals avoid filing claims for fear of being denied, subjected to endless delays, or even penalized with higher premiums. This reluctance undermines the very purpose of insurance, to provide a safety net when risks become reality. In essence, policyholders are paying for coverage they may never feel comfortable using, turning insurance into a one-sided transaction that disproportionately benefits the insurer. At a societal level, the erosion of trust in insurance undermines the stability of entire communities. Insurance is a cornerstone of economic security, enabling individuals and businesses to recover from losses and continue contributing to the economy. When insurance fails, the burden shifts to other entities such as government disaster relief programs, charities, and even the courts. These systems are not designed to replace the comprehensive protections that insurance should provide, leading to gaps in recovery and increased strain on public resources. The legal system also bears the weight of the defend strategy. Insurers' aggressive litigation tactics clog the courts with cases that could have been resolved through fair settlements. By forcing claimants to sue for what they are owed, insurers create an adversarial environment that benefits only their bottom line. The cost of litigation further discourages many policyholders from pursuing valid claims, effectively silencing those who lack the financial resources to fight back. For those who do pursue legal action, the process is often grueling and prolonged, with insurers employing every possible tactic to delay resolution. Feinman emphasizes that the broader impact of these practices is not merely financial or legal but also ethical. Insurance operates on a social contract. Policyholders trust insurers to uphold their promises, and insurers rely on policyholders to pay premiums and avoid fraudulent claims. When one side consistently breaks this contract, the entire system begins to crumble. The shift from mutual responsibility to profit maximization represents a betrayal of the values that originally defined the industry. This erosion of trust has long-term consequences, making it harder for individuals to feel secure in an increasingly uncertain world. The societal cost is particularly evident in how these practices exacerbate inequality. Vulnerable populations, those with lower incomes, less access to legal resources, or fewer options for alternative coverage are disproportionately affected by delays, denials, and aggressive defenses. For these individuals, the failure of insurance to provide timely support can mean the difference between recovery and financial ruin. In this way, the systemic issues within the insurance industry contribute to broader patterns of economic inequality and social instability. Feinman argues that addressing these broader impacts requires systemic change. The insurance industry must be held accountable for its practices through stronger regulations, increased transparency, and meaningful penalties for bad faith conduct. Policymakers must ensure that insurers prioritize their obligations to policyholders over their profits. At the same time, consumers must be empowered with the knowledge and tools to advocate for their rights, from understanding policy language to documenting claims thoroughly and seeking legal help when necessary. Ultimately, the broader impact of the delay, deny, defend strategy is a loss of faith in one of the pillars of modern economic life. Insurance is meant to be a source of stability in an unpredictable world, yet its transformation into a profit-driven enterprise has left countless individuals and communities struggling in its wake. Restoring trust in the industry will require more than incremental reforms. It will demand a fundamental reevaluation of the values and priorities that guide insurers today. While the practices of delay, deny, defend can leave policyholders feeling powerless, J.M. Feinman emphasizes that consumers are not entirely at the mercy of the insurance industry. Although the system is tilted in favor of insurers, there are strategies and actions policyholders can take to protect themselves and push back against unfair treatment. Beyond individual action, Feinman also discusses systemic reforms that can help restore balance and accountability in the insurance industry. For policyholders, preparation begins long before a claim is ever filed. One of the most important steps is understanding the details of an insurance policy. Policies are often dense and filled with technical jargon, but knowing what is covered, what is excluded, and what the policyholder's obligations are can prevent surprises down the road. Feinman advises reading the fine print and asking questions before purchasing a policy. For instance, does a homeowner's insurance policy cover water damage caused by storm surges? What documentation is required to support a claim? Being informed about these details helps policyholders avoid pitfalls and ensures they can act quickly and effectively when filing a claim. Documenting everything is another critical step in navigating the claims process. From the moment an incident occurs, policyholders should gather and organize all relevant information, including photos, receipts, medical records, and witness statements. This documentation can serve as vital evidence if the insurer disputes the claim. For example, when Terry Buttery filed a homeowner's insurance claim after his property was vandalized, he meticulously documented every aspect of his loss. This included receipts for stolen items, repair estimates, and even tax returns. While the insurer still delayed payment, Buttery's thorough documentation ultimately helped him win in court. His case highlights the importance of being proactive and prepared. When filing a claim, policyholders should also be persistent and assertive. Feinman notes that insurers often count on claimants to give up or accept lower settlements out of frustration. By following up regularly, keeping records of all communications, and insisting on clear answers, policyholders can signal that they are not willing to be dismissed easily. It's important to ask questions when insurers deny or delay claims. Why was the claim denied? What additional documentation is needed? Persistence can sometimes be enough to push a claim forward, especially when insurers realize the policyholder is willing to challenge their decisions. If the claims process becomes particularly contentious, seeking legal assistance may be necessary. Many policyholders hesitate to hire lawyers, fearing the costs or complexity of legal action. However, Feinman points out that lawyers specializing in insurance claims can level the playing field. In cases of bad faith or systemic delays, legal representation can pressure insurers to act fairly and even lead to additional compensation. For instance, when Cindy Robinson struggled to get her medical bills covered after a car accident, hiring a lawyer helped her recover the full amount owed, plus damages for the insurer's bad faith practices. While litigation can be time-consuming, it is often the only way to hold insurers accountable. In addition to individual actions, Feinman advocates for broader reforms to address the systemic issues in the insurance industry. One of the most pressing needs is stronger regulation. Although insurance is heavily regulated, much of the focus is on financial solvency rather than claims practices. Regulators need to prioritize the enforcement of fair claims handling standards, ensuring that insurers do not delay or deny claims without justification. This includes imposing meaningful penalties on companies that engage in bad faith practices. Currently, many insurers view fines as a cost of doing business, but stricter penalties could deter such behavior. Transparency is another key area for reform. Feinman argues that policyholders should have access to clear and comprehensive information about insurers' claims practices. For example, companies should be required to disclose data on how often they deny claims, the average time it takes to process claims, and the outcomes of bad faith lawsuits. This information would empower consumers to make more informed decisions when choosing an insurer. It would also incentivize companies to improve their practices, as they would be held accountable by both regulators and the public. Consumer education is equally important. Many policyholders do not fully understand their rights or the claims process, leaving them vulnerable to exploitation. Feinman suggests that state insurance departments and consumer advocacy groups play a larger role in educating the public. This could include providing plain language explanations of common policy terms, offering guidance on filing claims, and sharing resources for disputing unfair decisions. An informed consumer is less likely to be intimidated or misled by delay and denial tactics. On a larger scale, Feinman calls for a cultural shift within the insurance industry. Companies need to recognize that their long-term success depends on rebuilding trust with policyholders. This means returning to the original purpose of insurance, providing security and peace of mind. While profitability is important, it should not come at the expense of fairness and customer service. Insurers that prioritize transparency, fairness, and prompt claims handling can differentiate themselves in a competitive market, ultimately benefiting both their customers and their bottom lines. Feinman also highlights the role of collective action in driving change. Policyholders can join forces through advocacy groups, class action lawsuits, or public campaigns to demand better treatment from insurers. After Hurricane Katrina, for example, thousands of policyholders filed lawsuits and complaints, drawing attention to the industry's systemic failures. While individual efforts can make a difference, collective action amplifies the voices of consumers and puts greater pressure on insurers to reform. Ultimately, Feinman's message is one of empowerment. While the insurance industry has become increasingly profit-driven, policyholders are not powerless. By taking proactive steps, seeking help when needed, and advocating for systemic change, consumers can protect themselves and push back against unfair practices. At the same time, policymakers and industry leaders have a responsibility to restore fairness and accountability to an industry that is essential to economic stability and personal security. The delay, deny, defend strategy represents a betrayal of the trust that policyholders place in insurers. But as Feinman emphasizes, this trust can be rebuilt. By addressing the systemic causes of these practices and empowering consumers to advocate for their rights, the insurance industry can once again fulfill its promise of providing protection and peace of mind. It will require effort, vigilance, and reform, but the result will be an insurance system that works not just for the companies that profit from it, but for the people it was designed to serve. The conclusion of this chapter reinforces the idea that while the insurance industry's practices of delay, deny, and defend are deeply entrenched, they are not insurmountable. By understanding these tactics, taking proactive steps to protect themselves, and advocating for systemic reform, consumers can push back against unfair treatment. Feinman reminds us that the ultimate goal of insurance should be to provide security and peace of mind, and reclaiming this promise will require both individual vigilance and collective action. Restoring trust in the industry is possible, but it demands accountability, transparency, and a renewed commitment to fairness. Thank you for joining me on this deep dive into Delay, Deny, Defend by J.M. Feinman. This book sheds light on the hidden tactics of the insurance industry and serves as both a warning and a guide for anyone who relies on insurance for financial protection, which, let's face it, is all of us. From understanding how insurance is supposed to work, to uncovering the systemic flaws, to learning how to protect ourselves as consumers, this exploration has shown us both the challenges and the solutions. The key takeaway? Knowledge is power. By educating ourselves about these practices and advocating for transparency and fairness, we can take steps to ensure that insurance fulfills its promise to protect, not exploit. If you found this summary helpful, consider diving into the book for even more insights and actionable advice. Don't forget to like, subscribe, and leave a comment below with your thoughts or your own experiences with the insurance industry. Together, we can keep this conversation going and help others navigate the complexities of a system that affects so many. Thanks for watching, and I'll see you in the next video. Stay informed, stay empowered.